Welcome to the Big Fat Real Estate Checks podcast with Marco Kozlowski, where we help investors like you get the knowledge and skills you need to replace your JOB with passive cash flow for life.
Hey everyone, welcome to Big Fat Real Estate Checks. My name is Marco Kozlowski. I'm here with Gabriele Galluccio and Francesco Araish.
Oh.
Just kidding. We are all brothers from another mother.
Mothers, I guess.
The first time I've done that. I thought it was going to be funny, but apparently it really confused both of you. Sorry about that, boys and listeners.
Actually, we just thought
I'm always
we know our names, I think.
I am the village idiot around here. Always want to surround myself with people smarter than you. That's the secret to success, really. And welcome, listener. If this is the first time, please listen to the first 10 podcasts. The first 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. Explains asset-based lending, explains how we buy assets using skills and not money. And specifically in this economic cycle, we can always buy assets using existing debt as well if you know how and if you have the skills to do so. And if you have not subscribed already, please do so. We always welcome 5-star reviews and we always welcome great feedback. So I'm looking forward to hearing from you. And our mission, our vision, our purpose is to give you absolute phenomenal information, accurate information, and up-to-date information on how you can leverage knowledge into passive income and a better lifestyle. So I'm joined today with my two compadres. The three musketeers are together. And I know that we have not been pumping out podcast after podcast after podcast as we historically have. As the times change, so do we, and our mission is to give you really great episodes without necessarily getting a whole bunch of guests. In fact, we've done hundreds of episodes, no guests, and we're probably going to get to the point where we're going to have to bring in a couple guests because we're always hitting ourselves against the wall, thinking, what are we going to talk about next that we haven't talked about yet? And then Gabe is like, nope, talked about that, nope, talked about that, nope, talked about that, nope, talked about that, and he goes, nope, talked about that too.
Nope.
And I think we finally got a topic today after 3 hours, 12 minutes, and 19 seconds of heated debate on a call that I did a couple of days ago, just a couple of days ago, with a syndication. We've been talking about how the market has shifted. Many people bought into assets, multifamilies, or other projects in a 5-cap market. Money was below 5, so you basically make the spread, and if you increase the value of the asset by increasing the rents and optimizing the asset, then there's a really nice fat little check for you, because a 2% spread can be millions of dollars really on an upside. However, a 2% dip is also millions of dollars on a downside, which means that if you have really put your chips put all your chips on just an upside, and not realize that when money is more expensive, the market turns and you have to exit, you're going to be in big trouble. And I predicted well before November. We're in November right now. I predicted this in July, August. I was saying that as the Fed raises the interest rate and the market slows down, which it has considerably, you're going to have some syndications that are going to want to exit because they've either promised to exit. Their interest rates do not permit them to keep the property, or there's a balloon on the mortgage, or there's personal circumstance. There's a situation of some kind where syndication, which is where, for those of you that don't know what a syndication is, I'll have Gabriel explain this, and basically where you have investors that are wanting their money back, and you got to sell the property to make that happen. Or there's no syndication, and they did it illegally, bad boy, where they just took money, bought something, don't have any paperwork, and now they're in deep shit because they shouldn't have done that without a syndication. So, here we go. What happens when shit hits the fan, investors want their money back, syndicators, or there's a change in market cycle where they've promised or they're obligated, because there could be something in the PPM, which Gabe will explain in a second, that basically says, hey, this is an indefinite investment, or maybe they put in a very specific end date of 5 to 7 years. We must sell within that amount of time. You get your money back, And they did that because they wanted to placate their investors. Suddenly that's happened, and they're in that cycle now. And like, shit. Now the market's terrible, and we have to sell, and everyone's going to lose money. But we're obligated to because that's what the paperwork says. So, Gabe, what's a syndication? What's going on?
Well, you basically described it. A syndication is simply the act of raising capital from investors, outside investors or from the public markets without it being on a public exchange. So if, you have a deal and you need $1 million in order to be able to close on the deal, then you can just go see a bunch of investors or one or, ideally you want less, but one or more investors that are, from the public and asking them to bring the money in exchange of a piece of the pie or a piece of equity in the deal. And now this is kind of just a broad way of saying this, but there are, legalities around how to do this the right way. And that's not something we're going to get into because none of us here are attorneys or even pretend to be ones on podcasts. So we highly recommend that you, if you are going to get into a syndication, because it is a really good tool for growing your real estate portfolio, that you do discuss this with an SEC attorney or at least a real estate attorney that has experience with syndications, in order to make sure that you're respecting the rules, the compliance rules, when taking other people's money. And you can't take money from anyone. There are specific people that you're allowed to take money from and others that you are not. So, but that's what a syndication is. It's basically raising money in order to close on a deal. And it's for a specific deal. So if you have building A, you have a contract on it, and then you need money, you're going to raise money for that specific deal. That's what syndicating is. Because if you're just raising money with the idea of buying a property, you don't know which one is, that's known as a fund.
Got it.
Yay.
So.
Okay, so let's get into the nuts and bolts.
Well, what happens? Well,
what happens?
Let's play out a scenario.
The fan, right? Like in this case, right? So no, but the scenario was established, I believe, right? That you got into a syndication. Are we discussing this from
both
the operator's
Let's start with
perspective,
investors. Let's start with investors.
So you're an investor. You invested in a deal. You had to vet it yourself. You were presented with some materials, whether it was a PowerPoint presentation or a private placement memorandum, which is just a document describing the opportunity. In there, you've made the decision that you're going to invest some money because the deal is supposed to be a deal that they've acquired at, let's say, a 5 cap. The idea was to, by bringing up the revenues, you'd be able, and optimizing the property, bringing up the revenues, you'd be able to increase the value of the property. And then you would be exiting around the same 5 cap, maybe even a 4.5 cap. And now all of a sudden, interest rates went up and just, got your whole deal in shambles. And now your value has gone down. The value of the property has gone down significantly because the interest rates have gone up significantly. Now you're upside down.
Can I just let me do
flow.
The math for those that are listening and maybe don't understand the difference between a 5 cap and a 7 cap. So if someone has $100,000 net income, if your property has $100,000 net income, and you take $100,000 divided by 0.05, that's a $2 million value. Now you take that same $100,000 and now it's a 7 cap market, you're looking at about a 1.4 and change valuation. So there's a $500,000 plus spread on that 2% return difference. So if you came in at a 5 cap market and you borrowed 80% from a bank, 80% of $2 million is 1.6. Now the market shifted and you want to get out of your property and it's shifted in the wrong direction from a 5 cap to a 7 cap, your $1.6 million loan is now is greater than the $1.5 million value. It's 1.4 and change, 1.448 or something. I have to look at a calculator, but it's a significant problem in that now you owe more than the actual value of the property itself. So if you're in a syndication where you shoved $100,000, $50,000, your life savings, whatever it is, and it was done properly, and there could be a timeline where you are promised your money out, or it could be an indefinite where we're just going to keep the money until it's the best time to close. However, if there are market shifts or there's a capital call, which Frank will get into, I think, then what? Like, I gave all my money to you. The market has shifted. Now the value of the property is actually a lot less. So selling my shares doesn't make sense because they're worth less than they were before. Or maybe I want to do that just to recover some cash, or I don't even know I can do that, for example. And now there's a capital call. Frank's the operator. He says, hey, I need money. Hey, I need it now or else.
Actually,
but I don't have any money.
Before we go down there, so one thing.
Oh.
Well, hold on. I just wanted to add something here.
Hey.
Well, before we go down to the capital call, all right? Not down anywhere, but yes. Hey.
You got the blurry background today, buddy.
Well,
I gotta ask
not
the
blurry
question.
on this side. But anyways, yeah, just because your value. So the scenario that you painted, Marco, that doesn't concern me as much as most of these syndication, they get variable adjustable rates. So when they get a mortgage, they don't usually get a fixed 25-year AM, 30 AM, and so they have a variable rate. So it goes up and down with the market, with the prime. That's where the pickle is, basically. That's where if the property's making, if it's a 5 cap, and now their rate, maybe they got it at a 4 before, or 3, or actually as far back as even June, I think you're still able to get a 2.5 mortgage rate. So now their mortgage rates are a lot higher. So now they're having a cash flow problem. So now they're having a cash flow problem. That's why they're going to demand a capital call. So it's not so much the value, because if you don't crystallize the loss, if you don't sell the property, you don't crystallize the loss, right? So just because the value is off, that's an important factor. But the most important one is the cash flow. And if there's not enough cash flow to, meet your debt obligations, pay your managers, and operate the actual property, that's where the capital call comes in. So yeah, I'm calling everyone and say, hey man, guys, we're in a situation. We need some capital. We need an infusion of capital now. And whatever that capital call is, we need $1 million, or we need whatever it is. So every investor that came into this syndication is obligated to give X amount based on the proportion of their initial investment. So if they don't do that, again, it depends how it's written in the PPM or in this in the private placement memorandum. Does your shares diminish? The person that comes in with more money gets a preferred interest rate and they get paid first? There's so many variables that can go into there. That's where the problem lies. And vote I guess the investors, they have a right to vote as well. So if the general partner is in a pickle and they can't raise that capital they need, two things are going to happen. Two things are going to happen. Either A, someone's got to step up to the plate, or B, whoever they got a loan from, so they usually leverage their loan from a bank or whatever, they're going to come knocking on the door and say, hey, we need the money. And if they don't need the money, they're going to foreclose, and then everyone will lose their fucking shit. And that's not good.
If it forecloses, it's all gone. Game over.
It's all gone. So, and this is the debate we were having before in syndications. Some of them, I think most of them do have a time period where they have to sell. Gabe's saying it's almost like a stock where you can buy into it and you can actually exit anytime you want. But
Well, no, I'm saying that there's a proposed date and proposed exit plan, but that proposed exit plan could be extended indefinitely based on the market situation, and which is different than a fund, for example, because a fund, first of all, in a fund you'll have
right,
tons of investors compared to a syndication typically. So even though there is an opportunity to extend the date, so they have to have a hard stop, which is usually 5 to 7 years in real estate, and then they have the option in there to extend, for a year or two, but they need a unanimous decision, for example, or really high percentage, which generally it could happen, and it's happened before, but for the most part, an indefinite extension is not something that would happen. Whereas in a syndication, because there's less investors, depending on the situation, they might be able to do that, where they can extend it 2, 3, 4, 5 years without having as much of an issue as a fund would have, for example. That's what I'm saying. But there is no hard stop. Like in 5 years, we're selling no matter what. That in my opinion, doesn't happen in syndication. I just don't see it make sense. But again, every syndication has its own rules. You write your own rules, and the investors choose to agree and abide by those rules when they invest and sign the subscription agreements. So it's really what's written in your documentation. So as an investor, as a side note, make sure you understand these events, especially if you're investing, if you're investing now with this in this market, just make sure you understand what happens in the case, that shit hits the fan. What are your rights? What could happen? What would you do if, those clauses would be triggered? But yeah, I get that, that you think that there's an exit that's
fine. Even if the exit's not there, here's the situation we're in. So we're at a variable rate. Yeah. It goes up. We're screwed. We can't pay. I come to you clowns and say, hey guys, you guys are the syndicators. Say, hey guys, I need 500. Pony up. I need 500,000 each. We need a capital call to meet our and yeah, Marco raises his hands like, I'm
a little old lady, and I just gave you everything I have. I gave you my entire life savings because I was told by someone that I trusted that you were a good guy.
I am a good guy. It wasn't me. It was Guido. But yes,
right.
But see, so when,
or you're just a savvy investor, see where this is going, and are comfortable with losing what you've already put in and don't want to lose any more.
But that's what I'm saying.
It could just be that as well, where you're making.
But that's what I'm saying. If I don't collect money from the little old lady, being Marco, and yourself, then I got no choice. The banks are going to step in. They're taking the property, and that's where the opportunity lies. That's what's going to happen.
Correct.
It's a domino effect. Not so much the value of the property is lower, because it is lower, because that can always bounce back within 5-7 years with time. But in terms of the cash flow, that's a real problem. If it's bleeding every month, no one's going to buy your position. So forget about who's going to buy your shit. See how I'll sell you my position so you can lose money? Exactly.
As you mean as an investor, like if
nobody's going to buy your,
grand,
even if you sell it at 80, no one's going to say forget
units,
it's going down.
Percentage,
all right.
Well, from an investor side, or let me just step away from this conversation for a second. There are two things that will fuck you in this business. Number one is buying it incorrectly, buying it retail, and number two is bad management. And there's a lot of, now, what if, so one and the other so anyone that bought at retail with bad management is now going to suffer, right? So you could keep doing capital calls, but imagine being in a syndication where every month you're being asked for money now. You put money in and you're just asking for money and suddenly say, you know what, screw this. And so there's 20 people. The first month, 18 do it, then 15, then 14, then 13, eventually dwindles down to nobody wants to do it anymore.
None.
And they're now very angry. And now you're the operator that realized, well, now I can't exit because the market shifted. I'm running out of money because my property management is nickel and diming me because I didn't know that, and they locked me in for a year. A lot of these property management companies will lock you in for a year, and they'll bankrupt the business before they let it go if you're not careful. Ask us why we know this, right? So you have to have the right clauses in your or addendums in your agreement to make sure that doesn't happen. So you've got this angry group of partners of limited partners that have invested in this deal, saying we're not investing this anymore. The market's gone up. You have bad management. They bought it wrong. What happens? What do we do? So I'm using a real scenario because one or the other is going to happen. I've had multiple calls just this week on this. So now what?
Well, as I think at this point, as an operator and as a limited partner, so whether you're an investor or you're the person who structured this deal, you want the same thing. You just want to get out of this with the least amount of damage, right? I mean, that's I think what it comes down to. As an investor, depending on the mindset of the investor, they're going to be angry for sure. But would you prefer? Let's say you invested $100,000. The first option is the bank. Once you default on the payments a couple of times, they're going to come and foreclose and take the property. So option one, as an investor, yields you with zero of that $100,000 back. So your other option would be to sell the property for whatever's owed on it, plus hopefully as much as you can, so that the shareholders or the investor, so for everybody who's invested 100 grand, maybe they get 10 grand back, 20 grand back, 30 grand back, and basically limit their losses. Whereas the operator obviously will leave there with losing nothing other than any money they've put in, if they've put in any money.
But hold on a second.
Those are
but that's
only-
provided
you're
you
upside down right now.
You're upside down, exactly. So you're selling. You got to go back to the bank and say, we can't give you everything. So either you got to get a modification.
You're short.
You're short.
Yeah.
It is a short.
No, you're short. Yeah, you're short.
So I think that option is off the plate right now, that you can sell and never mind getting something. You're still on the hook for the bank, right? The bank's got their teeth sunk into that. If you owe the bank X amount and the property went down because the market slowed down, you're up shit's creek. And I
Sounds like
Again, depends on the value you were assessed in terms of your LTV when you
But-
got in.
well,
Yeah,
if it's,
Yes,
80,
okay,
if it's
I
an
see what you're
80-20
saying.
at 5 and you're doing
Yeah.
80-20 at 7, you're upside down, buddy. Like it's
Either way, you're well. Then
Or-
the bank is going to take back the property. That's your,
No, there is
There's
an
really
out.
no out. Or
wait, there's
not- there
more.
but
no, there isn't.
For the
I'm
average
saying
Joe,
for
there's
the
no out.
average
You're-
Joe,
you're
there's no
done.
out. That's what
yeah.
you see.
So if you're listening to this and you're an
Yeah.
operator,
You're
Or
going
an
to take a
investor, you're
haircut,
more an
and so is the
investor in
bank. But
something
the
like
bank's
this.
ultimately taking back the property, but they're
Well-
also taking a haircut.
and in my world, that's the best scenario ever in our world, in the tribe. Like this is the exact scenario that we absolutely adore because we can actually help the operator, we can help the investors, and we can help the bank, and we can just step in and actually just sprinkle some magic fairy dust and ba-ding, we bring it back to life. And this is the kind of deal that we love. So this whole conversation so far is, what's happened, where, this doom and gloom, oh my gosh, everyone's losing their money, but we can actually step in and save the situation in many cases. If it's an adjustable rate mortgage that goes from, 5% to 10% when the return is not going to cover the money, there could be ways of refinancing
There's still a remedy
the
on
first
there.
out.
There's still a remedy
There's
there.
there's a lot of remedy.
Yeah.
There's a lot of things that we can do.
Yeah.
You know what we're
I
talking
know what I'm
about,
talking. I know what I'm
Except
talking
we're
about.
not. If you were at Ninja, you know what I'm talking about. So there's a lot of things that we can do. A lot of things that we can do. Very Ninja things that we can do. And the point of this conversation, not to make a long story even longer, is knowledge applied is extremely powerful, and ignorance is very expensive. And many syndicators, either operators or investors, passive investors, have put money into a project, hoping the market goes up, always buying retail because that's what everyone says you should do, which I don't understand. We've never bought anything retail unless we're doing a debt takeover of some kind, which is exactly what we're discussing now, even on assets that are due on sale clauses up the ass, impossible, can't be done, never going to happen. Well, guess what? It's very possible if you know exactly what to do and how to do it with the right paperwork and the right structures, and there's nothing the bank can do about it. So if you're an investor that has put money into a syndication and you're being nickeled and dimed on that, please let us know. I'm not saying that we promise to be able to help you, but at least we can take a look at it and see if it's something that we can what we can do, and take a look at your PPM. Again, we're not attorneys, nor do we play one on TV. I'm not going to give you any legal advice. That's not my job. However, if there is a syndication that is not doing well and all the investors want to exit and they prefer to take a little bit than nothing, there could be solutions there depending on how the deal is structured. And that's the kind of deal that really excites us because we like helping people. And if you, as an investor, were to get a chunk instead of nothing, I think that's definitely better than zero. And as an operator, if you can get out from underneath it and without having the scar of losing everyone's money, I think that's a win as well. So I think we can.
Well, I think it's your responsibility,
absolutely.
like your fiduciary responsibility, to be able to go get, or salvage as much as you can to help your investors.
Absolutely. And if it goes from a 5 to a 7, and the mortgage is more now than the actual value of the asset just because of this market and what the money's costing for this period of time, no agent's going to touch it anyway to get it sold. There's no money in it. Yeah,
There's no money for
commission
them.
on it.
No
So
commission.
it's a win-win-win if you just look at it that way. So hopefully you survived this episode. I appreciate you both very much. Again, Francesco Galuccio, Gabriel Araish. See, I can't say it properly. And your almost fearless leader, Marco Kozlowski. Please like us, love us, share us, and we appreciate your comments, feedback. If you have any questions, email us, Marco@MarcoKozlowski.com, Marco@MarcoKozlowski.com. We appreciate your listenership, and we look forward to the next episode. Thanks, gentlemen. Bye for now, and crush it. This is a great time to be in the business. Best time in the last 14 years, in my opinion. Doodles. See you soon.
If you like this episode of Big Fat Real Estate Checks, then show some love by leaving a comment and a good rating. Also, as a thank you for tuning in today, we've got a special free gift. The journey to passive cash flow for a life starts by finding deals, and it's easier than you think. Simply go to getdealsbytuesday.com, enter your email address, and we'll send you a free quick start course called Deals by Tuesday. Even if it's 11 p.m. Monday night, this course will show you how to find discounted real estate deals by Tuesday. It's that fast and simple. Go to getdealsbytuesday.com and start your journey toward life-changing cash flow today. Thanks for tuning in, and we'll see you on the next episode.